A very good evening to all of you. Welcome to another YouTube live session with me, Srujit Kakkar. Today is Thursday, 2nd of Jan 2019. And before we start with the session, let's get done with the formalities. So make sure you people go through the disclosure. I'll keep it for a few seconds if you're watching it. Yes, definitely Pratik, I'm live, right? I'm doing the session live. So yes, make sure you go through this disclosure, and I'll keep it for a few seconds. If you're watching it as a stream, you can pause it. If you're watching it as a recording, you can still pause it. We have two pages which talks about the disclosure, and now that we are done with this formality, let's get started with today's session, which is about candlesticks. Perfect. So we'll talk about candlesticks. A very good evening to all of you. And yes, I'll definitely add that what we'll do is we'll get done with the session first. And once we are done with the session, then I'll look into the messages which I have in the chat box, right? So if you have any questions, queries, you can put it in the chat box. And if you want me to take certain topics for which you have certain, questions, so just make sure you put it in the comment section. I'll take those topics. Over a period of time, I've been noting down the queries I've been getting in the comment section, and yes, slowly and steadily I'm taking these topics. So do make sure if there is certain topic you're looking for, put it in the comment section. I'll definitely do that. And yes, I would also like to add that the timings for these sessions are not predefined. Whenever I have time, I start with these sessions. So to get notified when these sessions are happening, make sure you subscribe to my channel, hit the bell icon and select all notifications. Before the session starts, 10-15 minutes before that, I start with the countdown timer that will notify you that the session is about to start in about 10 minutes or 15 minutes, so that you can position yourself in a way so that in case you want to join the session live, you would be able to join it live. So yes, talking about candlestick chart. So what are candlestick charts? So candlestick chart is a type of chart that typically is used to illustrate the price movement of any financial instrument over time. So the range of the candle represents the highest and the lowest price over 1 unit of time. Now, what do we mean by 1 unit of time? In case you're using a 1 minute chart, so it is telling you over that 1 minute time period, what was the high, what was the low, what was the open, what was the close. Similarly, if you're looking at a hourly chart, so it is telling you that during that 1 hour of unit, right? What was the opening price, what was the high price, what was the low price, and what was the closing price. So the body of the candle represents the opening and the closing price of that period, and it is identified by looking at the color of the candle. So what is going to happen is, now let's imagine, our markets, they open at 9:15. So at 9:15 the market will open at certain price, and after that it can move up or it can move down. So whenever the prices are above the opening price, the color would always be green. So if the closing is above the opening price, it will be green in color. And in case the closing is below the opening price, it will be red in color. So now by opening and closing, we mean that unit of time. So let's imagine we opened at 9:15 and now we are looking at a 1 minute candle. And after a minute, the prices are closing above the opening price, then the candle color would be green. If you are looking at a 5 minute chart, so the closing at 9:20, because from 9:15, 9:20 would be 1 5-minute unit, and wherever we are closing, if it is above the opening price, it will be green in color. If it is below the opening price, it will be red in color. In fact, let me do this just to explain you this better. Let's go to a market which would be trading live as of now, and let me show you as an example. That is something we can do. So just give me a second. So probably we can go to, let's say, GBP USD, and what I'll do is I'll go to a very small time frame, which is a 1 minute chart. Right now, the reason I'm doing this is just to show you and help you understand how these candlesticks are formed. So we'll wait for a minute so that a new candle starts forming, and then we'll talk about it. So because I'm on a 1 minute chart, what will happen is one candle will be forming every minute. So we have as of now 30 seconds before this candle closes, because can you see we are on a 1 minute chart, so every 1 minute new candle would be forming, and can you see prices are moving up, prices are moving down. The reason is because of the transactions which are happening. So let's wait for another 18 seconds, then this candle will close. So we'll take 1 or 2 examples so that you can better understand how these candlesticks, they get formed. So in about 10 seconds this candle will complete and a new minute will start. And as soon as the new minute starts, we'll get our opening price, right? Let's wait for 3 more seconds, 2 seconds, 1 second, and done. So now you will see a new candle will start forming. Just give me a minute. So there you can see, and this is just give me a, so this is where we opened. Oops, why am I not able to use the, anyway, so this is my opening price. Now can you see after the opening, as if now the prices are transacting above the opening price. That is the reason the color of the candle is green. If the transactions they start happening below the opening price, you will see the color will change to red. Now can you see we are again back to the opening price, we are still above the opening price. Now this is my high as of now, and can you see as soon as it went below the opening price, the color changed to red. Now again it is back to green, because based on where the closing price is with corresponding, I mean with corresponding to your opening price, that is how the color of the candle is decided. So we still have another 9 seconds, 7 seconds. So once this will complete, I'll explain to you what happened during this 1 minute. So done. So what happened during this 1 minute? During this 1 minute, this is where we opened, right? That was our opening price of this 1 minute. This was the high price of that 1 minute. This is my low price of that 1 minute, and this is also my closing price. So the candlestick gives you the 4 price points, which is your open, high, low, and close. And now you can see the next minute a new candle has started. Now this is the opening price of this candle. As if now this is the high, but what can happen is during this 1 minute the high can change, the low can change. So we'll wait for another minute and see what happens. So let's take it as another example. So let this candle complete. So as of now, that's my high. Can you see now it has started making new lows? In case it moves up, you will see a wick at the bottom. Can you see now? You can see that wick because after this a transaction happened at a higher price. In case it continues up, it can convert into a green color candle. If it closes here, then this is what the structure of this 1 minute candle would be. So can you see now this candle has completed? That's my opening price, that's my high price, that's my low price, and that's my closing price. Alright, so now that we are done with how these candlesticks are formed, these are formed based on transactions which are happening in the market. And can you see it is representing the flow of price during that 1 unit. As of now, we were looking at a 1 minute chart, so it was telling us what was the open, high, low, close of that specific 1 minute. So let's move ahead. So this is what happens. Prices will open at certain price. After that, it will create some high, it will create some low that will be denoted by these highs and the lows of that candle, and then we'll be closing at certain price. In case we are closing above the opening price, the color would be green. Now what happened here, we opened at 100, first prices they moved down. At that point of time, this would be red in color. Then prices they started moving up, made a high of 106. Again prices they came down, but since we are closing above the opening price, it would be a green color candle. Similarly, let's assume we open at 104. That's the high, that's the low, that's the close. So what would have happened is after the opening, maybe the prices they went higher, then started moving lower, and then at the end of it they closed at 100 rupees. Since we are now closing below the opening price, the color of the candle would be red. So that is how these candlesticks are formed. So again, when you look at these candlesticks, these are called as your bodies, which is the colored part. The bodies, they always tell you the opening and the closing price. If the color is green, the opening is below, the closing is above. If the color is red, the opening is above, the closing is below. And the highest price is the high and the lowest price is the low. These can also be called as wicks. I mean, these are called as wicks. You can also call them as shadows. You can also call them as tails. So these are different terminologies people use. So candlestick is made up of 2 parts. It will have the body, it will have wick. Yes, at times you will see candles which will not have either of the wicks, because that means the high and maybe the closing is exactly the same, or the low or the opening is exactly the same, which is where the wicks can be also missing at times. Let me show you some examples maybe on the chart. So if we look at this candle, can you see now this one does not have a lower wick. Why? Because the closing price and the low price is exactly the same for this candle. Give me a minute. So for this candle, the opening and close is exactly the same. That's the reason we don't have a bottom wick. Similarly, if you look at this candle, this also does not have a bottom wick, which means my opening price and the low price is exactly the same, right? Let's take another example. If you look at this candle, can you see it doesn't have the upper wick, it doesn't even have the lower wick. So what does that tells me? That my opening and my high are exactly the same price, and my closing and my low are exactly the same price, right? So that is the information which we get from the candlestick chart, which is on that specific period of time, what was the high, what was the low, what was the open, and what was the close. Let's move ahead. So again, if you're looking at a chart, let's imagine that's my open, high, low and close. Because we are closing above the opening price, it would be a green color candle. Again, we have open, high, low, close. Because we are closing below the opening price, it would be a red color candle. We have open, high, low, close. Because we are again closing below, red color candle. Open, high, low, close. Because we are closing above the open, green color candle. In this case, the opening price and the closing price are exactly the same, which is why we don't have any body. And since there is no body, we don't have a green color, or we don't have a red color because the body is missing. So open and close are exactly the same. Then we have our high and the low. And what I'll do is I'll show you a few examples. But before we get into some examples, let's move on to the next step. So now that you understand how the candlesticks they get formed, right? People, they use these candlesticks to identify something which is called as candlestick patterns. Now, if you talk about candlestick patterns, there are n number of candlestick patterns available. So probably it can be in few hundreds. So if I just do a Google search, you can see I just did a Google search for candlestick patterns. Can you see there are so many patterns? So what do? People who want to trade based on candlestick patterns, they start learning these patterns, right? There are a lot of patterns. Like I'm just showing you example, but what we'll do is we'll just talk some of the major candlestick patterns which a lot of people they use. Like example, you have dojis, you have dragonfly dojis, you have hammer, you have inverted hammer, right? You have hanging man, you have gravestone, right? Then these are now one candlestick pattern. Similarly, you also have candlestick patterns which are made up of multiple candles. Example, you can see you have your bullish harami, you have your bearish harami, you have your dark cloud cover, engulfing bullish, then you have your falling window, morning star, evening star, three white soldiers, three black crows, right? So a lot of candlestick patterns. And what people they do is they look for these patterns on the chart, and once they see these patterns, and these patterns they talk about whether they should be taking a bullish position, a long position, or they should be taking a short position, because some of these patterns are bullish patterns, some of these patterns are bearish patterns. Now yes, people they do learn so many patterns, but what we do in our strategies, I teach you a very simple logic, and by learning that logic, doesn't matter whether it is 100 candlestick patterns or 1000 candlestick patterns, anyone throws any candlestick pattern at you, you will be able to identify whether it is a bullish pattern or whether it is a bearish pattern. So I don't make you learn all these patterns, I just simply teach you a logic. That is what we teach in our POS and POS Plus course. What is the logic we are looking at, and just by understanding that logic you can identify the candlestick patterns. And yes, I would also like to add that at the end of this session, once we start getting close to the end, I will show you something which is much more advanced versus candlestick patterns, which is again our demand and supply strategy. Why? Because like we discussed few sessions back, that your support and resistance, they get formed at your areas of demand and supply. Similarly, I will show you that even your patterns of candlesticks, they get formed at your areas of demand and supply. So I'll show you quite a few examples, and you will see that these zones, these candlestick patterns, they get formed in our demand areas, in our supply areas. So again, we have an advantage of using demand and supply, that we don't even have to wait for these patterns to form. Even before the patterns they get formed, you're already in the trade, right? So that is where you get an edge with demand supply methodology. So let me show you some examples. Or in fact, what I'll do is I'll start with some recent examples from the session which we did last Sunday. So can you see when we did the session last Sunday? Let's start from here. Now, even while we were doing the analysis last evening, can you see that was the time when the prices, they just touched the supply area, and now we got a reaction from this supply. Now this was planned well in advance, right? So we planned this on Sunday when nothing was here, right? And now can you see when the prices they came back, we have this formation of a pattern. Now what is this pattern called? You can probably call it as a bearish harami, right? So if I go back to that Wikipedia page, you will see this is the kind of pattern which is called as a bearish harami, right? Can you see it's something like this, a bearish harami, or you can even call it as bearish harami cross. So we have a similar kind of a pattern on the chart as of now. Can you see that? A similar pattern, but where did the pattern form? The pattern formed because of our supply area. So what is going to happen is, if you were a demand and supply trader, you would have already entered the trade. Oops. Just give me a second. I don't know why my drawing tools all of a sudden stopped working. Right, so if you're a demand and supply trader, you would have already entered the trade somewhere around here. Now people who are waiting for the confirmation of that pattern to form, now this is where that pattern formed. So what is happening is whenever you're waiting for that pattern, your risk is always increasing. And let's assume if this was my reward, then your reward is also reducing because you're taking a late entry. So this is where you also have an advantage, that with demand and supply, you are in the trade even before all these patterns they get formed on the chart. And that is what you can see. The pattern formed later, and even before the pattern formed, we were already in the trade. Now let me show you another example. If you look at this, and now can you see this was not the one. I guess it was on some other script. Let me find it for you. Okay, this is GBP USD, right? So the other one was S&P 500. So can you see, even on S&P 500, when you had this bearish engulfing, that bearish engulfing happened in our supply area. So later people got to know that maybe we have a pattern which is a bearish pattern, but you were in the trade probably even before the pattern was formed. And again, if you remember last night, we were talking about that yes, now people will start seeing it as an area of resistance. For us, this no longer has any meaning. So I'll not be surprised if the prices, they just go right through the zone. And that is what you can see happen today, because we have talked about it in the past, that when it comes to demand and supply, we believe the opposite. People who believe in support and resistance, they believe the more number of tests, the stronger the zone is. We believe the more number of tests, the weaker the zone is. And you can see the zone got easily violated. Now let me show you a few more examples. So we'll start with this. So if you look at this trade, which is Adani Ports, let me bring this up for you. There we have it. So you can see I shared this trade, which is Adani Ports, on 3rd of December at around 4:12 p.m. and the trade was 370.90. You can go short. 370 is your stop loss, 365.30 is your target one. So again, if you go back to the chart, this is on, okay, so now let me do this. This is Adani Ports. Let me show you on a 5-minute chart first. So can you see when the prices, they came to the zone, which is right here. So can you see we planned it on 3rd, on the 5th prices they came back. And now you have this pattern, and this pattern is called as 3 black crows, right? If I go back to show you, can you see this is the pattern which is called as 3 black crows. So when you have 3 consecutive candles, which are bearish candles, something like this, the rules are provided. That is what we call as a 3 black crows. But where did the 3 black crows form? Can you see they formed inside of your supply area? So by the time people, they started seeing it as a bearish formation, probably you're already in the trade, right? Let me show you another example. If you look at the same zone on the 15 minutes time frame, can you see it's your bearish harami, right? Again, it's just that on a 15 minutes chart, it looks like a different pattern. On a 5-minute chart, it was looking like a different pattern. But again, both the patterns are getting formed in your supply area. If you look at the same thing on the hourly chart, now can you see it's the same area, but now it's a structure of a shooting star. Can you see now it's a shooting star? So this is what we call as a shooting star. And what I can do is I can again show you, oops, my bad, just give me a second. Let's get back and let me show you the shooting star. Can you see this is the structure of a shooting star, right? The shooting star is something like this, and that is what you can see now on the 60-minute chart. So can you see it's the same supply zone, which on a 5-minute chart is forming a different pattern, on a 15-minute chart is forming a different pattern, on a 60-minute chart is forming a different pattern. But we were able to identify that where that reversal can happen well in advance, and that is where that reversal happened. And now people, they start seeing those patterns and they start jumping onto it. So again, as a demand and supply trader, you're the first person to enter the trade before everyone else starts seeing those patterns, be that candlestick patterns you're using, be that support and resistance you're using. I've shown you both the examples in the last few days. Now let me bring up more examples for you. So if you look at the next one, which is Axis Bank, let's bring up Axis Bank. AXISBANK, Axis Bank. So Axis Bank, we will be looking at 5 minutes chart. Let's go to 5 minutes chart because I noted down, these examples. So can you see on Axis Bank, this is where you have your bearish harami pattern, right? It's called as a bearish harami pattern. But if you look at this pattern, can you see by the time you had that confirmation that the pattern has formed on this script, and if you're trying to take the trade now, what has happened is you have already increased your risk, because this is where you'll be having your confirmation of the pattern. So something which you could have traded with this much risk, now you're trading probably with a bigger risk if you're waiting for the confirmation of that pattern. Plus what is happening is, let's assume if this was your target, if you entered here, you have this as your reward, but if you're entering late, now your reward has also reduced, right? So that is the advantage of demand and supply, that you don't even have to wait for these patterns. As a demand and supply trader, you will be the first person to enter the trade, and the patterns will be forming later. Let me also show you the same thing on a 4-hour chart. So if I go to this on a 4-hour chart, on the 4-hour chart, it's a shooting star. So can you see again, it just touched the same zone and formed the shooting star. So again, if you're trying to enter the trade by now, if you would have entered here, now you already have 1:1. That is where you can make your trade as a break-even trade. So you're again one step ahead of everyone else who is waiting for the patterns to get formed on the charts. Let's see if we have more examples. Let me find more examples for you. Alright, so here's an example of a long trade, which is Divis Lab, was shared on Sunday 15th of December. Let's bring up Divis Lab, D-I-V-I-S Lab, and here I'll show you on 5 minutes, 60 minutes and 30 minutes on 3 different time frames. So let's start with 5 minutes. So can you see, this was a trade which was planned on 15th. On 5 minutes chart, we had a formation of you can call this as a a hammer, right? That's the structure of hammer. If I go back to the candlestick patterns, you can see this is called as hanging man, or you can also call it as a hammer. Can you see, that's the formation of a hammer, and that is what we have here, that we have a hammer forming on the chart. But again, if you look at it, you were the first person to enter the trade. Later that hammer was formed. If I go to the next time frame on the same script, which is 30 minutes. Now, depending upon what time frame you're using, yes, you might be getting those candlestick patterns early or maybe a little late. Now here you can see we have a bullish harami, right? So that's the structure of a bullish harami, and by the time you're getting this confirmation, you're already at 1:1, right? As a demand and supply trader, you're already almost at 1:1, and by the time you're getting that confirmation, you're too much delayed. Why? Because now you can see a trade which you could have entered here with just this much risk. By the time you get your confirmation, probably you have double the risk. And let's assume if 2:1 was your target, now by the time you're entering, your target is a little over 1:1. If you entered here, you had a 2:1. So that is the advantage. The sooner you enter a trade, the smaller the risk, the bigger the reward. The more delayed you are, the bigger the risk, the smaller the reward, right? So that's the advantage of demand and supply methodology. Now let me show you the same thing on a 60 minutes time frame. So on 60 minutes also, I guess it was a hammer formation. There you can see it. Now you have this hammer forming, and by the time you have this hammer forming, already 1:1 move is already gone. So what I'm trying to show you here is that there is something which is again one step ahead of candlestick patterns, something one step ahead of support and resistance, something one step ahead of chart patterns, which is your demand and supply methodology. Now yes, these trades I have not shared with you. These are only shared with the POS Plus subscribers, but at least you can look at these trades which I share with you on the Sunday sessions, right? The zones which I'm drawing for you. Now can you see, even if you talk about this one, this probably, if you want to call it as a bullish engulfing, maybe ideally we would like to see prices going a little low, below this, to call it as bullish engulfing. Maybe if I go to some other time frame, it might be a different kind of a pattern. So let's see, if I go to an hourly chart, you will still be seeing some pattern forming here. And let's see what can be the pattern, right? So you can call this as maybe the 3 black soldiers, right? So that's the pattern of 3 black soldiers. And after that, we are having that move to the upside. But again, you can see you would be the first person to enter the trade before everyone else starts seeing those patterns on the chart. Now let me see, do I have more examples listed for you? I'm just trying to double check that. No, so that was the last example. Great. So this is what I wanted to show you, that yes, in again candlestick patterns, people are looking for patterns, and again, even when people they use candlestick patterns, they don't use it standalone, right? Which means just because you see any pattern on the chart does not mean it's a trading opportunity for you. People are again using these candlestick patterns along with something else, right? That something else can be your support and resistance, that something else can be your oscillators, That something else can be your Bollinger Bands. Your something else can be demand and supply. But the fact is, with demand and supply, you don't even need these patterns, because you will be in the trade even before these patterns they get completed on the chart. And that is how demand and supply methodology gives you an edge, that you're not getting delayed. You are in the trade well before anyone else starts seeing those patterns on the chart. So that brings us to the understanding of what candlesticks are and how you have an advantage with demand and supply, which is beating the candlestick patterns, and you are in the trade way before anyone else starts seeing those candlestick patterns. So now let's get started with the Q&As. Just give me a second. Let me bring up the Q&As. All right. Alright, so very good evening to everyone. Interesting topic. I wanted to learn this. So Pratik, yes, the topic was candlestick patterns, but what I'm trying to show you here is that if you know demand and supply, you don't even need to learn candlestick patterns, because you can see these candlestick patterns, they get formed later. And what is creating these candlestick patterns? It is again your area of demand and your area of supplies, right? And again, if you want to learn candlestick patterns, yes, there are hundreds of candlestick patterns. And like I said, I teach a simple logic in our POS and POS Plus course, and that simple logic will help you identify any pattern. You don't even need to know the names of those patterns. It's a simple logic which we apply, and that simple logic helps you understand whether the pattern is a bullish pattern or a bearish pattern. And based on that, you can always make your decisions in case you use candlestick patterns. But with demand and supply, that is not even required. Yes, we do use them at times, but very rarely. Alright, crude oil, please. So Pramod, we will not be getting into the analysis of scripts. We only do that analysis on the Sunday session. So today we are into the education mode, and I only wanted to cover the topic which was candlestick patterns. That is what I wanted to do today. How to put this particular indicator of demand and supply, please guide. So Pratik, this is a subscription based indicator. It is not a free indicator. Let me again quickly show you. Just give me a second. Let's go back to the charts. So, oops, my bad. Just give me a second. Let me bring this up. Perfect. So this is a indicator which is a subscription based indicator. To get this indicator on your charts, you'll have to subscribe for it from my website. But yes, we also have a demo version available. So if you go to the indicator list and search for my name, Surjit Kakar, you can see the demo version is also available. The demo version will only work on the daily time frame. So at least you can apply to the daily time frame and you can try it out if you like it. But one thing which I would like to add here is, if you don't know demand and supply methodology, then all by itself these demand zones and supply zones which the indicator is marking has no meaning. So the first thing is you need to know the methodology. Once you know the methodology, then yes, this indicator can definitely help you. But without the understanding of demand and supply, standalone, the indicator will not have any meaning. So if you know the strategy, demand and supply strategy, and you want to use this indicator to make it easier for you to identify these areas of demand and supply, you can subscribe for it from our website. So you can go to my website, which is, let me just quickly show you, sk.uac. Alright, so just give me a minute. Let me bring it up for you. Just a second. Right, so let me just bring it up for you. Just give me a few more seconds. Alright, so now you should be able to see it in another few more seconds. So once you go to our website, you can see under all products, we have a product which is called as demand and supply zone indicator. So this is where you can subscribe for it and provide your TradingView username. Once you subscribe for it, it takes a few hours. We'll get it activated for you. Once activated, then you will be able to use on any time frame. But yes, the demo version, you can definitely try it out on the daily time frame if you wish to. That is definitely free. Alright, so let's again move ahead with the Q&As. Let's bring this up. Name the indicator. The name of the indicator is demand and supply zone indicator. Like I just showed you, if you search for it, you will find two versions. One is the demo version, which will only work on the daily time frame, and we also have the paid version which will work on all time frames. Alright, so yes, today's session I had to do a little early because I was not available in the evening. So I thought instead of skipping the session, why not to do the session a little early. I know a lot of people might have not been able to join this session live. But yes, the recording is available, so make sure that you go through if you're going through the recordings, and if you still have any questions, queries, make sure you put it in the comment section. I'll definitely help you with your questions, queries. How to start looking for this demand and supply. See again, Rajesh, this is a process which we teach in our course, right? So this is something you will have to learn the complete process, and it's not something like, it's a magic formula that you learn it and from the very next day you're the best person who is able to identify demand and supply. So what happens is you need to have that extended hand holding, and that is what we do in our POS Plus course, that we have 3 live sessions every week where I show you how to identify these areas of demand, areas of supply, how to qualify them, how to understand their quality, how to understand their probability, how to put it all together and understand which zones to use, which zones not to use. And you get that hand holding for a 30-day subscription or a 30-day or a 60-day subscriptions, and you can even renew it. So as long as you feel that confidence, you can renew it. What I'll generally say is that if you are putting in efforts, you're doing your homework, 60 days is more than sufficient to understand the whole process. That is the reason I have the 60 days. Now somebody who is already having a very good trading experience, even 30 days is more than sufficient to understand the whole strategy. But yes, that is something, it cannot be covered in the YouTube sessions, because these sessions is not where we'll be covering the demand and supply methodology in depth. That is something which we do in our course. Great. So that brings us to the end of today's session. Thank you so much for joining in. I will be seeing you very, very soon. Make sure if you have any questions, you have any challenges, you want me to take topic, you want me to take that as a topic, put it in the comment section. I'll definitely do that. And don't forget to subscribe the channel, because like I said, these sessions are not predefined at what time I'll be taking these sessions. Based on my availability, I do these sessions. So if you're subscribed to my channel, what is going to happen is you'll get the notifications before the session starts, and then you'll be able to join the session live. Thanks, sir. Demand and supply indicator and PS. You're most welcome, Deepak. All right, so that brings us to the end of today's session. Enjoy your evening. Take care. Bye-bye.